Susannah, we have to begin on this conflict, of course, really raising tensions in the region. But how are you reading the impact on risk assets and safe havens so far?
Well, certainly, I think investors are bracing for a fresh jolt of volatility, and certainly we've been seeing that playing out to some extent in Asia today, with indices falling back, with risk-averse appetite really increasing as that sentiment of concern about the situation unfolding in the Middle East spreads. Certainly when you heard those comments from CEO Jamie Dimon of JP Morgan Chase about just the potential for these conflicts to escalate and make the world a more dangerous place, it does concentrate minds, even though, as you say, certainly the earnings beat was pretty positive for JP Morgan, given the upwards effect of the higher interest rate environment which has had on its earnings. But certainly over the longer term, there will be concern that what you're seeing playing out now is fresh evidence of geopolitical fracture, of course, coming on the top of what's happened in Ukraine, concerns as well about the tensions between the US and China. Although in the short term, I think we're still fixated to some extent on what's happening in terms of central bank policy, but this concern about geopolitical tensions is going to be bubbling along in the background for some time, and of course it's going to be coming to the fore when we hear about all the latest really concerning developments in terms of the war in Israel and Hamas.
Indeed, Susannah, and what we're seeing now is markets kind of having two focuses here, as you say, on the macros still and looking at the macroeconomic picture, the Fed trajectory, given the latest data, but at the same time, rising geopolitical risk, not just because of Ukraine, but also now the situation unfolding in the Middle East. What would you say is the biggest risk for markets at this point, and how do you want to be exposed in this environment?
Certainly at a time like this, what you're seeing is diversification, but a lot of holding in cash, and also still maintaining quite large holdings in US tech. I think a diversification really needs to go much further than that. Clearly, investors are expecting that we are at the kind of turn of the cycle, because the expectation is that interest rates, have peaked. There is uncertainty, of course, that is still hanging around, certainly given what you saw with the inflation numbers in the United States last week, concerned that actually perhaps the Fed isn't quite done. And then, of course, hinging on all of those comments that we're getting out, drip feeding of comments from Fed policymakers, again, perhaps indicating that the Fed is actually done with rate hikes. Right? But overall, we are nearing the end of the cycle, but of course, we're expecting it to be many months before we're seeing a cut. So, of course, this higher interest rate environment is going to be sticking around for some time. And as it does so, we are expecting these bouts of volatility to continue until there is a firmer path ahead. And of course, looking to an era of lower interest rates, bonds would certainly come back into focus again, and also equities. And there, I think it would be useful to look at some of the sectors where perhaps equities have been very undervalued of late. So looking at the UK, for example. So certainly need to go further in the diversification strategy than just holding US tech and cash.